Hello and welcome. In the complex world of United States finance and taxation, two professions often stand out: the accountant and the tax attorney.
Disclaimer: this video is for informational and educational purposes only and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.
For many, these titles might seem interchangeable, both dealing with numbers, regulations, and the IRS. But in reality, they operate in fundamentally different arenas and offer distinct forms of protection and expertise. The purpose of this series is to illuminate that critical line, to explore the unique and powerful role of a U.S. tax attorney, and to clarify the specific situations where their skills become not just beneficial, but absolutely essential. Let's begin with the familiar. Your certified public accountant, or CPA, is your trusted financial quarterback for navigating the annual tax season and beyond. They are experts in the language of numbers, organizing your financial records, preparing accurate tax returns, and helping you strategize to legally minimize your tax burden through deductions and credits. Their work is primarily about compliance and reporting. They ensure that your financial history is presented correctly and in accordance with the current tax code. For the vast majority of individuals and businesses with straightforward tax situations, a skilled accountant provides everything they need. The landscape changes, however, when your tax situation shifts from a matter of reporting to a matter of dispute. This is where the tax attorney steps in. The most fundamental difference between an accountant and a tax attorney isn't their knowledge of the tax code. Many CPAs know it inside and out. The difference is that a tax attorney is a lawyer. They have graduated from law school and have passed a state bar exam, giving them the license to practice law. This legal credential unlocks two critical capabilities that an accountant simply cannot offer: legal representation and the protection of attorney-client privilege. First, let's consider legal representation. Imagine you've received a notice from the IRS stating that you are being audited, and the agent believes you owe a substantial amount of money, perhaps with penalties for fraud. Your accountant can help you gather your receipts and explain how they prepared your return. But if the dispute cannot be resolved and you need to challenge the IRS's decision in a court of law, your accountant cannot represent you. Only a licensed attorney can file petitions, argue cases, and represent a client's interests in U.S. tax court. A tax attorney is your legal advocate, trained in the art of argumentation, evidence, and legal procedure. They don't just present the numbers, they build a legal case around them. The second, and perhaps most vital, distinction is the concept of attorney-client privilege. When you communicate with your tax attorney for the purpose of seeking legal advice, that conversation is legally protected and confidential. This means the government generally cannot force your attorney to testify against you or reveal what you discussed. This protection is a cornerstone of the American legal system, designed to allow clients to be completely honest with their legal counsel. This is not the same for an accountant. While there is a limited form of accountant-client privilege, it is not as broad or as strong. Crucially, it does not apply in criminal tax investigations. In such a case, the IRS could subpoena your accountant and compel them to turn over their records and testify about your conversations. With a tax attorney, that legal shield of privilege remains firmly in place, providing you with a secure environment to discuss all aspects of your situation, no matter how sensitive. So, as we begin this journey, think of the distinction like this: an accountant helps you document and report what has happened. A tax attorney is there to defend you, advocate for you, and protect your rights when what has happened is under legal scrutiny. In our next chapter, we will delve deeper into the first arena where this difference becomes starkly clear: the IRS audit. Welcome back. In our first chapter, we established the fundamental difference between an accountant and a tax attorney, the line between compliance and legal advocacy. Today, we're going to explore one of the most common and stressful situations where that line becomes critically important: the IRS audit. First, let's demystify the word audit. An audit is simply a review by the IRS to verify that the income and deductions you've reported on your tax return are accurate. It doesn't automatically mean you've done something wrong. Audits can be triggered for a variety of reasons, from random selection to specific items on your return that fall outside the norm. They can range from a simple request for documentation sent by mail, known as a correspondence audit, to a face-to-face meeting with an IRS agent. In the initial stages of most audits, your accountant is your most valuable asset. The IRS is, at this point, asking questions about the numbers. Your accountant, who likely prepared your return, is the best person to answer those questions. They can efficiently gather the necessary documents, organize receipts, and provide schedules that explain the financial data. Their job is to demonstrate that the return was prepared correctly based on the information provided. They speak the language of the revenue agent and can clear up misunderstandings about your financial records quickly and professionally. However, an audit can sometimes evolve beyond a simple verification of numbers. It can become a dispute over the interpretation of tax law itself. This is where a tax attorney's unique skill set comes into play. For example, the IRS agent might question whether a particular business expense was ordinary and necessary, or they might challenge the legal structure of a transaction. This is no longer a math problem, it's a legal argument. A tax attorney is trained to research legal precedent, cite relevant court cases, and construct a formal legal argument to defend your position. They advocate for your interpretation of the tax code, a role an accountant is not licensed to perform. The situation becomes even more serious if the IRS auditor begins to suspect wrongdoing and suggests significant penalties, such as the civil fraud penalty. This penalty is severe, 75% of the tax owed, and it changes the entire dynamic of the audit. The focus is no longer just on correcting a mistake, but on defending against an accusation of intentional deceit. A tax attorney is equipped to handle these high-stakes negotiations. They can build a case to show that there was no fraudulent intent and work to have such penalties removed, protecting your financial future in a way that goes far beyond simple accounting. Finally, there is a critical red line in any audit. In rare instances, an IRS agent may find what they believe to be evidence of tax evasion. At this point, they can refer your case to the IRS's Criminal Investigation Division. Once this happens, you are no longer in a financial dispute. You are in a potential criminal matter. This is the moment where the attorney-client privilege we discussed in Chapter 1 becomes your most important protection. All communication should immediately be handled by a tax attorney to protect your constitutional rights. An accountant can be compelled to testify against you in a criminal case. A tax attorney cannot. In short, during an audit, your accountant manages the records, but a tax attorney manages the risk. They control the flow of communication to the IRS, handle the legal arguments, and serve as your dedicated advocate and defender when the stakes are highest. Thank you for joining me. In our next chapter, we'll discuss what happens when you and the IRS simply cannot agree. The world of IRS appeals and litigation in U.S. tax court. Welcome back. In our last chapter, we examined the IRS audit process and saw how a routine review of numbers can escalate into a legal disagreement. But what happens when the audit concludes, and you and the IRS are still fundamentally at odds with the outcome? This is a critical juncture where you must decide on your next step. Today we'll explore that path. The IRS administrative appeals process, and if necessary, litigation in the United States Tax Court. When an audit results in a proposed tax increase that you disagree with, the IRS will typically send a letter explaining their findings and your rights. One of those rights is the ability to appeal their decision internally, before an independent branch of the IRS, known as the Office of Appeals. The entire purpose of the appeals office is to resolve tax disputes without the need for expensive and time-consuming court proceedings. This is a crucial, and often very effective, step in the process. Here, both an accountant and a tax attorney can represent you. An accountant can be very effective at the appeals level, especially if the disagreement still centers on factual or accounting issues. They can present your case to an appeals officer, who is tasked with taking a fresh, impartial look at the facts and the law to see if a compromise can be reached. The appeals officer has more flexibility than the initial auditor, and is often focused on the hazards of litigation, meaning the chances the IRS might lose if the case were to go to court. However, the involvement of a tax attorney during the appeals process introduces a powerful new dynamic. Because a tax attorney has the ability to take the case to the next level, tax court, their negotiations with the appeals officer carry an implicit weight. They are not just arguing the facts, they are negotiating from a legal standpoint, fully prepared to litigate if a fair settlement isn't offered. They analyze the case like a lawsuit, identifying legal strengths and weaknesses, which can lead to more favorable settlement terms. If the appeals process does not result in an agreement, the IRS will issue a formal document called a Notice of Deficiency, often referred to as a 90-day letter. This letter is your official ticket to court. It states that you have 90 days to file a petition with the U.S. Tax Court. If you fail to file within that window, the proposed tax becomes legally assessed, and the opportunity to challenge it before paying is generally lost. This is the absolute, uncrossable line where an accountant's role as a representative ends and a tax attorney's role becomes exclusive. Unless your accountant has passed a special, rigorous examination to become a U.S. tax court practitioner, they cannot file a petition or represent you in tax court. Litigating in tax court is the practice of law. A tax attorney is your legal champion in this arena. They will draft the legal petition, manage all court deadlines, engage in discovery to obtain evidence from the IRS, file legal motions, negotiate with IRS attorneys, and if a settlement can't be reached, conduct a trial before a judge. In essence, while your accountant helps you argue about what the numbers say, your tax attorney is the only one who can argue your case before a judge when there's a dispute about what the law itself means. Their expertise in legal procedure, rules of evidence, and courtroom advocacy is something that falls completely outside the scope of the accounting profession. Thank you for joining me. In our next chapter, we will shift our focus from disputes to solutions and discuss a powerful tool for taxpayers with overwhelming debt: the offer and compromise. Welcome back. In our previous chapters, we focused on disagreements with the IRS, audits, appeals, and the tax court. But what happens when the issue isn't a disagreement over the amount of tax owed, but rather an inability to pay a tax debt that you know is correct? For individuals and businesses facing overwhelming tax liabilities, the IRS has a program that can sometimes offer a path forward. It's called an offer in compromise, or OIC. An offer in compromise is an agreement between a taxpayer and the IRS that settles the taxpayer's tax liabilities for a lower amount than what they originally owed. This isn't a program for everyone. The IRS approves an OIC only when the taxpayer can demonstrate that they cannot pay their full tax debt, or that doing so would create a significant economic hardship. The IRS will look at a taxpayer's ability to pay, their income, their expenses, and the equity of their assets to make a determination. The process of applying for an OIC is incredibly detailed and requires a comprehensive disclosure of your financial life. This involves filling out extensive forms, providing detailed financial statements, and submitting a mountain of supporting documentation. A certified public accountant, or CPA, can be instrumental in this phase. Their expertise in organizing financial data, preparing accurate financial statements, and ensuring all the numbers are correct is invaluable. They can assemble the complex financial picture that the IRS requires. However, an offer in compromise is not just a financial application. It is a formal negotiation with a federal government agency. This is where the skills of a tax attorney become uniquely powerful. While an accountant presents the financial facts as they are, a tax attorney frames these facts within a legal and strategic context. First, the analysis of whether to even file an OIC is a complex legal and financial decision. A tax attorney can analyze the entirety of your situation, including other potential collection alternatives like installment agreements or currently not collectible status, to determine if an OIC is the most viable path. They understand the legal standards the IRS uses to evaluate these offers, such as the concept of reasonable collection potential. Second, during the review process, an IRS examiner will scrutinize your application. They may challenge your listed expenses, question the valuation of your assets, or disagree with your projected future income. These challenges often require more than just providing a receipt. They require a persuasive argument. A tax attorney is trained in the art of negotiation and advocacy. They can argue on your behalf, citing regulations and internal IRS guidelines to justify your position and counter the examiner's objections. Finally, if an OIC is initially rejected, you have the right to appeal that decision. Just as we discussed in the last chapter, this appeals process is a formal proceeding. A tax attorney can prepare and argue this appeal, presenting a legal case as to why the rejection was incorrect and why your offer should be accepted based on the law and the facts. They navigate the procedural rules of the appeal and represent your interests throughout. In summary, when pursuing an offer in compromise, an accountant is essential for building the financial foundation of your application. A tax attorney, however, builds the legal and persuasive structure upon that foundation, advocating for you through every stage of a challenging negotiation. Thank you for listening. In our next chapter, we will discuss another important area of tax law: protecting a spouse from the tax debts of their partner through a concept known as innocent spouse relief. Welcome back. So far in our series, we've discussed tax issues that arise from your own financial activities. But what happens when a tax debt originates from the actions of a spouse or former spouse? Under the U.S. tax system, when you file a joint tax return, both spouses are generally held equally responsible for the entire tax liability. This is known as joint and several liability. However, The law recognizes that it may be unfair to hold one person responsible for the tax errors or misdeeds of the other. This is where a set of provisions, collectively known as innocent spouse relief, can provide a crucial shield. Innocent spouse relief is a complex area of tax law that allows a person, in certain circumstances, to be relieved of responsibility for paying tax, interest, and penalties resulting from a joint return. There are a few different types of relief, but they all hinge on one central theme: fairness. The IRS will look at whether you knew, or had reason to know, about the incorrect item on the tax return that led to the tax debt. They will also consider whether you received a significant benefit from the unpaid tax, and whether it would be inequitable to hold you liable. Assembling a case for innocent spouse relief begins with facts and figures, a task where an accountant can provide significant help. They can assist in gathering financial records and demonstrating the flow of money to show that you did not benefit from the understatement of tax. They can help prepare the initial application forms and ensure that all the necessary financial information is presented clearly. However, a claim for innocent spouse relief is far more than just a financial declaration. It is a deeply personal and often legally complex case that you must build and prove. You are essentially arguing that, based on your unique set of facts and circumstances, it would be unjust to force you to pay the debt. This is where the role of a tax attorney becomes indispensable. First, a tax attorney understands how to gather and present the specific kind of evidence the IRS and the courts find persuasive in these cases. This often goes beyond bank statements. It might involve demonstrating a history of financial abuse, showing that your spouse was deceptive and hid financial information from you, or proving that you had no reason to question their financial dealings. This is the work of building a legal narrative, not just filling out a form. Second, the legal standards for qualifying for relief are nuanced. A tax attorney is trained to argue these points of law. For instance, they can build a case that you meet the specific legal definition of had no reason to know, or that holding you liable would be inequitable. They can cite previous court decisions and IRS rulings to support your case, framing your personal story within the established legal framework. Finally, if your initial request for relief is denied by the IRS, you have the right to petition the U.S. Tax Court. As we've established, only a licensed attorney can represent you in court. These cases can be very difficult and emotionally charged, and having a legal advocate to fight on your behalf is essential. A tax attorney can protect your rights and present your case to a judge, providing a level of advocacy that is simply not available from any other type of professional. In matters as personal and legally intricate as innocent spouse relief, a tax attorney serves as both your legal strategist and your dedicated advocate. Thank you for listening. In our next chapter, we will turn our attention to business owners and explore the complexities of employment tax issues. Welcome back. In this chapter, we are turning our attention to the unique challenges faced by business owners. Specifically, we're going to discuss one of the most serious issues in all of U.S. tax law: employment tax debt and a powerful enforcement tool known as the trust fund recovery penalty. When a business has employees, it is required to withhold certain taxes from their paychecks, primarily federal income tax, Social Security, and Medicare taxes. These are called trust fund taxes because the employer holds this money in trust for the U.S. government. The money never actually belongs to the business. The business is merely a temporary caretaker before passing it on to the Treasury. A responsible accountant or payroll service is absolutely critical for managing this process. They calculate the correct withholding amounts, process payroll, and prepare the quarterly employment tax returns, such as Form 941. Their role is to ensure accuracy and procedural correctness, making sure the business is compliant with its reporting obligations. However, when a business experiences cash flow problems, a dangerous temptation can arise. Using that withheld trust fund money to pay other pressing bills, like rent or suppliers, with the intention of paying the IRS back later. This is a critical mistake, because the IRS does not consider this a loan from the government. They consider it a failure to turn over government funds. When this happens, the IRS can invoke the Trust Fund Recovery Penalty, or TFRP. This is not a typical penalty. The TFRP allows the IRS to bypass the business entirely and assess the full amount of the unpaid trust fund taxes directly against the personal assets of any individual who was deemed responsible for collecting and paying the tax and who willfully failed to do so. This means the IRS can pursue the personal homes, bank accounts, and wages of business owners, corporate officers, bookkeepers, and anyone with significant financial control. This is a legal minefield. The IRS will conduct an investigation to determine who is a responsible person. This isn't just about job titles. It's about who had the authority to decide which bills got paid. They will also investigate whether the failure to pay was willful, which doesn't mean you had malicious intent. It can simply mean you knew the taxes were due and you knowingly paid another creditor instead. This is a scenario that extends far beyond accounting. This is a legal proceeding where you are defending yourself against a personal assessment that could be financially devastating. A tax attorney's role here is crucial. They will represent you during the IRS's investigation, which often includes a formal interview. They will manage all communications to protect your rights. Most importantly, a tax attorney can build a legal defense. They might argue that you were not, in fact, a responsible person, under the legal definition of the term, or they might argue that your failure to pay was not willful, perhaps due to a lack of knowledge or control over the situation. They can challenge the IRS's determination in an appeal and negotiate a resolution, such as a settlement or payment plan, based on legal arguments and your ability to pay. In matters of employment tax, an accountant manages the payroll. But when the trust fund is breached, a tax attorney is there to defend the people behind the business. Thank you for listening. In our next chapter, we will explore the complex world of international tax issues and reporting requirements for U.S. citizens. Welcome back. In today's interconnected world, it's increasingly common for U.S. citizens and residents to have financial interests outside of the United States. You might work abroad, own foreign property, or have a bank account in another country. What many people don't realize is that the U.S. tax system is based on citizenship, not residency. This means that U.S. citizens are required to report their worldwide income, regardless of where they live. This creates a complex web of international reporting requirements, and failure to comply can lead to some of the most severe penalties in the entire tax code. The two most well-known requirements are the FBAR and FATCA. The FBAR, or Report of Foreign Bank and Financial Accounts, must be filed with the Financial Crimes Enforcement Network, a bureau of the Treasury Department. It requires you to report foreign financial accounts if their combined value exceeds a certain threshold at any point during the year. FATCA, the Foreign Account Tax Compliance Act, is a separate rule that requires you to report specified foreign financial assets on a form filed with your income tax return. A knowledgeable accountant is essential for the mechanics of this reporting. They can help you determine which accounts and assets need to be reported, calculate their value in US dollars, and prepare the highly detailed forms, such as FinCEN Form 114 for the FBAR and Form 8938 for FATCA. This is a task that demands meticulous record-keeping and a deep understanding of the specific filing requirements. The role of a tax attorney becomes critical, however, when a taxpayer discovers they have failed to meet these obligations for past years. This is a very serious situation. The penalties for noncompliance, particularly for the FBAR, can be staggering. The government makes a key distinction between non-willful and willful failures to file. A non-willful violation can result in a significant penalty per account per year, but a willful violation can lead to penalties that are a substantial percentage of the account balances, and in some cases, even criminal investigation. Determining whether a failure to file was willful is a legal question, not an accounting one. It involves interpreting your specific facts and circumstances to assess your state of mind and intent. This is the domain of a tax attorney. They can analyze your situation under the protection of attorney-client privilege and advise you on the legal risks you face. Furthermore, if you need to come forward to correct past mistakes, the IRS has several complex voluntary disclosure programs, such as the Streamlined Filing Compliance Procedures. These programs allow taxpayers who were non-willful to get back into compliance with reduced penalties. Navigating these programs is a legal process. A tax attorney can guide you through every step, prepare the necessary legal narrative explaining your non-compliance, and represent you before the IRS, ensuring your rights are protected as you resolve these sensitive issues. In the world of international tax, your accountant files the forms. Your tax attorney is there to defend you when forms were not filed, and to navigate the legal pathways back to compliance. Thank you for listening. In the next chapter, we will discuss how a tax attorney can step in when the IRS's collection actions become aggressive, such as with liens and levies. Welcome back. Thus far, we have discussed how tax debts are determined and disputed. Now we turn to the sharp end of the process. What happens when a tax debt is final, but remains unpaid? The IRS has powerful tools to collect delinquent taxes, and two of the most significant are the federal tax lien and the IRS levy. Understanding the difference between them, and the roles professionals play in response, is crucial. First, let's define our terms. A federal tax lien is a legal claim the government files against all your property when you neglect or fail to pay a tax debt. It's a public notice to other creditors that the government has a right to your property, including property you acquire after the lien is filed. A lien secures the debt. It doesn't, by itself, take your property. A levy, on the other hand, is the actual seizure of property to satisfy the tax debt. A levy can take your wages, freeze and seize funds from your bank account, or even take physical assets like your car or home. A levy is an aggressive, active collection step, whereas a lien is a more passive, but still serious, claim. When a taxpayer is facing these actions, an accountant can play a very important role in communication and financial organization. They can help prepare the necessary financial statements, like Form 433A, to show the IRS your current financial situation. Based on this, they can help you negotiate a payment plan, known as an installment agreement, or apply for currently not collectible status if you can prove extreme financial hardship. Their work is focused on resolving the debt through financial arrangements. However, the legal nature of liens and levies means that many of the most powerful remedies fall exclusively within the expertise of a tax attorney. When the IRS files a lien or sends a final notice of intent to levy, they must also notify you of your right to a collection due process hearing, or CDP hearing. This is a formal legal proceeding before the IRS Office of Appeals, and it is a critical opportunity to challenge the collection action. A tax attorney is the professional equipped to represent you in a CDP hearing. In that hearing, they can do more than just offer a payment plan. They can make legal arguments against the collection action itself. They can argue that the IRS did not follow proper procedure, or that the levy creates an economic hardship so severe that it should be stopped. They can also use the hearing to propose collection alternatives, like an offer in compromise, all within a formal legal setting. If you disagree with the outcome of the CDP hearing, a tax attorney is the only one who can appeal that decision to the U.S. tax court. Furthermore, a tax attorney can negotiate legally complex solutions that an accountant cannot. For example, they can apply for a lien subordination, which allows another creditor to move ahead of the IRS, a step that might be necessary to get a mortgage or business loan. They can also apply for a lien withdrawal, which removes the public notice of the lien under certain conditions, helping to repair your credit. These are legal procedures, not accounting functions. In essence, when facing collections, an accountant helps arrange how to pay the debt. A tax attorney can legally challenge the collection itself and pursue specific legal remedies to protect your property. Thank you for listening. In our next chapter, we will discuss the vital role a tax attorney plays in strategic planning for complex business transactions and estate planning. Welcome back. In all our previous chapters, we've focused on the role of a tax attorney in a reactive capacity, solving problems that have already occurred. Now we're going to shift our perspective to one of the most valuable, yet often overlooked, functions they perform: proactive tax planning. This is the art and science of structuring your financial life, business transactions, and estate to legally minimize tax liabilities before they ever arise. When you are contemplating a major financial event, such as selling a business, buying a significant piece of real estate, or planning how to pass your assets to the next generation, an accountant plays a vital role. They are the masters of financial modeling. They can run the numbers, project the tax costs of a transaction under different scenarios, and tell you what the tax impact of a decision will be based on the current structure. Their work is quantitative and essential for understanding the immediate financial consequences of your choices. A tax attorney, however, is not just calculating the consequences of the plan. They are designing the legal architecture of the plan itself. Their primary question isn't, what is the tax on this transaction? But rather, how can we legally structure this transaction to achieve the most favorable tax outcome? Let's consider the sale of a business. An accountant can tell you the tax due if you sell your company's stock versus selling its assets. A tax attorney, on the other hand, will structure the entire legal framework of that sale. They will draft the purchase and sale agreement, using specific legal language to define the nature of the transaction. They can utilize advanced legal strategies, such as tax-free reorganizations or mergers.
Disclaimer: this video is for informational and educational purposes only, and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video, or the channel, will not be held liable for any actions taken based on the information provided.
That are fundamentally legal constructs designed to defer or eliminate tax. This isn't about accounting entries, It's about building the legal vehicle for the transaction. The same is true for estate planning. An accountant can calculate your potential estate tax liability based on the assets you currently own. A tax attorney designs the legal mechanisms to manage that liability. This is done through the creation of legal instruments like wills and, most importantly, trusts. There are many different types of trusts: revocable living trusts, irrevocable life insurance trusts, charitable remainder trusts, and more. Each is a distinct legal entity created for a specific purpose, often with tax minimization as a key goal. Drafting these documents, ensuring they are legally sound, and advising on which structure best suits a family's goals is the practice of law. In proactive planning, the accountant provides the essential numbers and financial data, while the tax attorney provides the legal strategy and framework. They work together to build a blueprint for your financial future, ensuring that the structure is not only financially sound but also legally optimized to protect your assets and minimize your tax obligations under the law. Thank you for listening. In our next chapter, we will delve into the world of tax-exempt organizations and the unique role a tax attorney plays in their creation and governance. Welcome back. Today, we're exploring a unique corner of the tax world: tax-exempt nonprofit organizations. These are the charities, foundations, educational institutions, and other groups dedicated to a public purpose rather than private profit. Achieving and maintaining tax-exempt status, often as a 501(c)(3) organization, is a complex process governed by strict legal requirements. It's a prime example of where accounting and legal expertise must work in perfect harmony. The role of an accountant is the lifeblood of a well-run nonprofit. They are responsible for the ongoing financial health and transparency of the organization. This includes meticulous bookkeeping, tracking donations and grant money, managing payroll, and critically, preparing the annual informational return, the Form 990. The Form 990 is a public document that details a nonprofit's finances, activities, and governance. An accountant ensures this form is accurate and filed on time, which is essential for maintaining public trust and compliance. The role of a tax attorney, however, begins before the nonprofit even exists and continues as a guardian of its legal status. First, the very creation of a nonprofit is a legal act. An attorney drafts the articles of incorporation and bylaws, which are the foundational legal documents of the organization. These documents must contain specific language and provisions required by the IRS to even be considered for tax-exempt status. Next, the attorney prepares the application for tax-exempt status, the Form 1023. This is not a simple tax form. It is a lengthy and detailed legal argument to the IRS. In it, the attorney must describe the organization's intended activities and demonstrate how they align with one of the legally recognized exempt purposes, such as charitable, religious, or educational missions. Getting this application approved is the single most important legal hurdle a new nonprofit must clear. Once exempt status is granted, a tax attorney continues to provide vital counsel on governance and compliance. The law places strict limits on nonprofits. For example, they are prohibited from allowing their earnings to improperly benefit any private shareholder or individual, a concept known as private inurement. There are also strict rules limiting their ability to engage in political lobbying or campaigning. A tax attorney advises the board of directors on how to navigate these rules, ensuring their activities don't jeopardize the organization's precious tax-exempt status. If a nonprofit is audited, the questions are almost always legal in nature, and a tax attorney is the one who defends the organization's mission and compliance before the IRS. In the nonprofit world, the accountant keeps the financial engine running smoothly and transparently. The tax attorney builds the legal chassis of the organization and ensures it stays on the narrow road of legal compliance. Thank you for listening. In our next chapter, we will return to the world of tax disputes and discuss criminal tax investigations. Welcome back. In this chapter, we must address the most serious situation a taxpayer can face: a criminal tax investigation. It is essential to understand that this is fundamentally different from a civil audit. A civil audit is about money. The IRS is trying to determine the correct amount of tax. A criminal investigation, conducted by the IRS's law enforcement branch, known as Criminal Investigation or CI, is about liberty. The goal is not just to collect tax, but to gather evidence for a potential criminal prosecution, which can result in felony convictions, massive fines, and prison time. This is the point where the roles of an accountant and a tax attorney diverge in the most absolute and critical way. Normally, your accountant is your trusted advisor. In a criminal investigation, however, they can become the government's #1 witness against you. The limited accountant-client privilege we've mentioned in previous chapters offers zero protection in a criminal case. This means that everything you have ever told your accountant about your finances, and every document you have given them, can be subpoenaed. Your accountant can be legally compelled to testify against you in a grand jury proceeding or at trial. For this reason, when a criminal investigation begins, the role of a tax attorney becomes paramount, and they are not just acting as a tax expert. They are acting as a criminal defense lawyer. The first and most important shield they provide is the attorney-client privilege. Under this protection, your communications with your attorney for the purpose of seeking legal advice are completely confidential. This allows you to have a full and honest discussion about your situation, which is necessary to build a defense, without fear that your words will be used against you. A tax attorney will immediately take control of all communications. They will instruct you not to speak with any IRS special agents, who are highly skilled federal law enforcement officers. Instead, the attorney becomes the sole point of contact. This prevents you from making any inadvertent statements that could harm your case and protects your constitutional rights, including your Fifth Amendment right against self-incrimination. The attorney's job is to defend you throughout the entire criminal process. They will interact with the IRS agents and federal prosecutors, analyze the government's evidence, conduct their own investigation, and identify weaknesses in the government's case. They will look for every available defense, such as arguing that any misstatements on your tax returns were not willful, but were instead the result of a mistake or negligence. Their goal is to persuade the government not to bring charges. If charges are filed, the tax attorney will represent you in federal court, prepared to defend your freedom at trial. In a criminal tax case, the line is clear. Your accountant can help explain the financial history. A tax attorney is there to defend your future. Thank you for listening. In our next chapter, we will discuss the concept of tax avoidance versus tax evasion, and why the difference is a matter of law. Welcome back. In the world of taxes, two terms are often used that sound similar, but are worlds apart in the eyes of the law: tax avoidance and tax evasion. Understanding the profound difference between them is essential, as one is a legal and encouraged activity, while the other is a serious crime. The line between them is a matter of law, and navigating it is a key area where a tax attorney's counsel is vital. Tax avoidance is the legal use of the tax code to reduce your tax liability. The U.S. tax code is filled with provisions that are intentionally designed to encourage certain behaviors. When you contribute to a 401k or an IRA, claim a deduction for mortgage interest, or take advantage of tax credits for energy-efficient home improvements, you are practicing tax avoidance. You are using the law as it is written to pay the lowest amount of tax that you are legally required to pay. A skilled accountant is an expert in tax avoidance. Their job is to know all the available deductions, credits, and strategies and to apply them correctly to your financial situation. Tax evasion, on the other hand, is the illegal act of intentionally and willfully underpaying your taxes. This is not about interpreting the law in your favor, it's about breaking it. Common examples of tax evasion include deliberately underreporting income, claiming deductions for expenses you never incurred, hiding money in offshore accounts without reporting them, or keeping a second set of books for your business. The key word that separates evasion from a simple mistake is willfulness. Tax evasion requires a criminal intent to defraud the government. This distinction between a legal strategy and a criminal act is precisely where a tax attorney's role becomes so important. While an accountant is excellent at applying established tax rules, some advanced tax strategies can fall into a gray area. A complex business transaction might be structured in a novel way that has not yet been tested in court. Is this creative legal tax avoidance, or is it an illegal tax shelter? Answering this question requires a legal analysis. A tax attorney can research relevant statutes, regulations, and court case history to provide a formal legal opinion on a proposed tax strategy. They can assess the risk that the IRS might challenge the strategy and analyze the potential legal consequences. This advice, protected by attorney-client privilege, allows a taxpayer to understand the legal boundaries before they act. If a taxpayer's return is challenged by the IRS, and the government alleges that a strategy crossed the line into evasion, the dispute is no longer about accounting. It's about proving legal intent. A tax attorney is the only professional who can defend you in court against an accusation of tax evasion, building a case to show that there was no willful intent to break the law. In short, an accountant helps you master the art of legal tax avoidance. A tax attorney is there to provide the legal opinion on whether a strategy is, in fact, legal avoidance, and to defend you if you are ever accused of crossing the line into evasion. Thank you for listening. In our next chapter, we will discuss state and local tax issues and how they add another layer of complexity. Welcome back. While the Internal Revenue Service, or IRS, is the federal agency that gets the most attention, it's crucial to remember that it is only one piece of the puzzle. Every taxpayer in the United States is also subject to a complex matrix of state, and in many cases, local tax laws. These can include state income taxes, sales and use taxes, property taxes, and franchise taxes for businesses. When disputes arise at this level, they require a specialized approach, and once again, the roles of the accountant and the tax attorney are distinct. State tax laws are not simply copies of the federal tax code. Each state has its own unique rules, regulations, and procedures. An accountant with expertise in a particular state's tax system is invaluable for compliance. They prepare state income tax returns, help businesses correctly collect and remit sales tax, and ensure that all state-level reporting is done accurately and on time. Their knowledge of the specific forms and rules is essential for day-to-day operations. However, when you have a significant disagreement with a state tax authority, like the California Franchise Tax Board or the New York State Department of Taxation and Finance, the dispute often moves into a legal arena. Just like the IRS, state agencies have their own audit divisions, appeals processes, and ultimately, their own court systems for resolving tax disputes. This is where a tax attorney licensed to practice in that specific state becomes necessary. If a state audit results in a tax assessment that you disagree with, your appeal might be heard by a state tax commission or an administrative law judge. These are formal legal proceedings. A tax attorney is trained to navigate this environment. They can file the legal protests, submit briefs arguing your case based on state law and precedent, and represent you in the hearing. A particularly complex area at the state level is the concept of nexus for businesses. This refers to the amount of connection a business must have with a state before that state has the right to tax it. With the rise of e-commerce, nexus has become one of the most heavily litigated areas of tax law. Determining whether your business has a legal obligation to collect sales tax in dozens of different states is a question of constitutional law, not accounting. A tax attorney can provide a legal analysis of your nexus footprint and defend your business against states where you believe you are not required to collect tax. Furthermore, if you cannot resolve your dispute at the administrative level, the case will move to the state's tax court or trial court system. As we've established in the federal context, only a licensed attorney can represent a client in court. A tax attorney can litigate your case, challenging the state's legal interpretation and defending your rights under that state's laws. In the multi-layered system of U.S. taxation, your accountant is your guide for compliance with state rules. Your tax attorney is your legal advocate when you have to fight a battle on that state's home turf. Thank you for listening. In our next chapter, we will discuss how tax attorneys work alongside other professionals to form a complete advisory team. Welcome back. Throughout this series, we have focused on differentiating the role of a tax attorney from that of an accountant. But in many complex financial situations, the most effective approach isn't a matter of choosing one professional over the other. Instead, it's about building a collaborative advisory team, where each member contributes their unique expertise to create a holistic strategy for the client. In an ideal scenario, a client with significant financial, business, or estate planning needs will have a team of 3 key players: the certified public accountant CPA, the financial advisor, and the tax attorney. Think of them as specialists, each looking at your financial life through a different, highly valuable lens. The financial advisor is focused on the future. Their primary role is to help you manage your investments and plan for long-term goals like retirement, education funding, and wealth accumulation. They are the strategists for growing your wealth, helping you understand risk tolerance and asset allocation. The CPA or accountant is the master of your current and past financial data. They are focused on compliance and reporting. They manage your books, prepare your annual tax returns, and provide a clear picture of your financial health today. They ensure the numbers are accurate and that you are meeting all of your regular tax obligations. The tax attorney, as we've discussed, is the legal architect and defender. They look at the legal structure of all your financial activities. They are focused on risk management, proactive legal structuring to minimize tax, and representing you in any legal dispute with a tax authority. So, how do they work together? Imagine you are selling a business you've spent your life building. Your financial advisor will help you plan how to invest the proceeds to fund your retirement. Your accountant will calculate the precise capital gains tax you will owe from the sale and ensure the transaction is reported correctly. But your tax attorney is the one who will have structured the legal terms of the sale agreement itself to ensure it was as tax efficient as possible from the very beginning. In estate planning, the financial advisor helps grow the assets in the estate. The accountant values those assets and handles the financial bookkeeping for any trusts. The tax attorney drafts the legal documents, the will and the trusts, that dictate how those assets are protected and transferred, ensuring the entire plan complies with the law and minimizes estate taxes. When these professionals communicate and collaborate, the client receives the benefit of a three-dimensional view of their finances. The financial advisor's growth strategy, the accountant's precise reporting, and the attorney's legal protection all work in concert. This team approach ensures that all decisions are vetted from every angle, which helps to prevent blind spots and creates a more robust, secure financial future. Thank you for listening. In our final chapter, we will summarize the key takeaways from this series. Welcome back for the final chapter of our series. Over the last 14 chapters, we have journeyed through some of the most complex and challenging areas of the United States tax system. Our goal was not to provide advice, but to provide clarity. The central theme has been to illuminate the distinct and separate roles of two vital professionals, the accountant and the tax attorney. Today, we will summarize the key takeaways. The fundamental distinction comes down to this. Accountants are masters of compliance, and tax attorneys are masters of advocacy. Your accountant is your expert for reporting your financial past and present. They organize your data, prepare accurate returns, and ensure you are complying with the tax code as it is written. They are the professionals you rely on for the annual rhythm of tax season, for sound bookkeeping, and for understanding the financial health of your business. A tax attorney, however, is your legal champion when the tax system is no longer about simple reporting. Their role becomes essential in several key situations we've discussed. First, in disputes. When you are facing an IRS audit that has become a legal argument, an appeal of an IRS decision, or litigation in the U.S. tax court, you are in the world of law. A tax attorney is the only professional licensed to represent you in court and to make formal legal arguments on your behalf. Second, in high-stakes resolutions. When dealing with overwhelming tax debt through an offer in compromise, or facing personal liability for business employment taxes through the trust fund recovery penalty, a tax attorney acts as your legal negotiator and defender. Third, in matters of legal protection. When seeking innocent spouse relief, navigating a criminal tax investigation, or needing to understand the fine line between legal tax avoidance and illegal tax evasion, the protections of attorney-client privilege and a deep knowledge of legal precedent are indispensable. And finally, in proactive planning. When you are legally structuring the sale of a business, designing an estate plan with trusts and wills, or forming a nonprofit organization, a tax attorney builds the legal framework to achieve your goals in the most tax-efficient way allowed by law. These functions all stem from the two unique powers that only a licensed attorney possesses: the authority to represent clients in a court of law and the protective shield of attorney-client privilege. By understanding these distinct roles, you are empowered with knowledge. You can better recognize the nature of the challenge you are facing and identify the right professional with the right skills for your specific needs. The goal is to ensure you have the correct expertise on your side, precisely when you need it most. Thank you for joining me on this journey. Welcome back. In this chapter, we step into one of the newest and most rapidly evolving areas of U.S. tax law: the world of cryptocurrency and digital assets. The IRS has made it clear that it is intensely focused on compliance in this area. Yet the official guidance often lags behind the technology. This combination of high scrutiny and legal ambiguity creates a unique set of challenges for taxpayers and highlights the distinct roles of accountants and tax attorneys. For anyone transacting in digital assets, a knowledgeable accountant is absolutely essential for the immense task of tracking and reporting. The IRS currently treats cryptocurrencies like Bitcoin and Ethereum as property, not currency. This means that nearly every transaction is a taxable event. When you sell crypto for dollars, trade one crypto for another, or use it to buy a product or service, you are likely triggering a capital gain or loss. An accountant's role is to meticulously track these transactions. This involves recording the purchase date and price, known as the cost basis, for every asset, and then calculating the gain or loss every time it's sold or exchanged. Given that a single person can have thousands of transactions across multiple exchanges and wallets, this is a monumental task of data reconciliation and calculation, which is then reported on the appropriate tax forms. The tax attorney's role, however, begins where the clear-cut calculations end. They deal with the legal uncertainty and interpretation. The technology of digital assets creates situations that the tax code was not designed for. For example, what is the precise tax treatment of staking rewards? Is it income when you earn it, or when you claim it? What about airdrops, where you receive new tokens for free? Or a hard fork, where a cryptocurrency splits into two? Answering these questions requires a deep legal analysis of existing IRS notices, court cases, and general tax principles to form a defensible legal opinion. Furthermore, if you have failed to report your crypto transactions in past years, correcting this is not just an accounting task. It involves significant legal risk. As we've discussed in other contexts, the government will be interested in whether your failure to report was willful. A tax attorney can guide you through a voluntary disclosure under the protection of attorney-client privilege, helping you come into compliance while managing the risk of severe penalties or a criminal investigation. Finally, if the IRS audits your return, the disagreements will likely be about these gray areas. An attorney is the only one who can argue the legal basis for your tax position and defend your interpretation of how the law should apply to these new technologies. In the world of digital assets, your accountant organizes the past and calculates the knowns. Your tax attorney navigates the uncertain present and protects your legal future. Welcome back. Real estate is one of the most common and powerful vehicles for building wealth in the United States. However, the sale of an investment property typically triggers a significant tax event: capital gains tax. To help investors keep their capital working, the tax code contains a special provision, Section 1031, which allows for what is known as a like-kind exchange. This is a prime example of a transaction that is governed by rigid legal rules, where both an accountant and a tax attorney play critical, but very different roles. A 1031 exchange allows an investor to sell an investment property and defer paying capital gains tax, provided they reinvest the proceeds into another, like-kind property. This is not a tax-free transaction, it is tax-deferred. You are essentially rolling your gains from one investment into the next. The role of the accountant in a 1031 exchange is focused on the numbers and reporting. They will calculate the capital gain that is being deferred, which is crucial for your records. They will also determine the carryover basis, the original property's cost basis that transfers to the new property, which will be used to calculate the gain on a future sale. Finally, they will properly report the transaction to the IRS by filing Form 8824, like-kind exchanges. Their job is to ensure the financial aspects are correctly documented. A tax attorney's role, however, is to manage the legal integrity of the transaction itself. A 1031 exchange will fail if you do not follow a set of strict, unforgiving legal requirements. And this is where an attorney is indispensable. First, the law has rigid deadlines. You have only 45 days from the sale of your property to formally identify potential replacement properties, and you must close on one of those properties within 180 days. A tax attorney helps manage this legal timeline and ensures all identifications are properly and formally documented. Second, you are not allowed to actually touch the money from the sale. The proceeds must be held by a qualified intermediary. A tax attorney advises on the legal necessity of this intermediary and drafts or reviews the legal agreements required for this arrangement to ensure you don't run afoul of the constructive receipt rules, which would disqualify the entire exchange. Third, an attorney structures the transaction's legal paperwork. They will ensure the purchase and sale agreements contain the necessary language to reflect the intent to perform an exchange, protecting you from future challenges. If the IRS ever audits the transaction, they will be scrutinizing the legal mechanics of the deal, not just the math. The attorney is the one who defends the legal structure they helped create. In a 1031 exchange, your accountant reports the numbers that result from a successful transaction. Your tax attorney builds the legal guardrails that make the transaction successful in the first place. Welcome back. For our final chapter, we will address one of the most significant and emotionally complex challenges a business owner will ever face: planning for their exit. Business succession planning is the process of creating a strategic plan to transfer ownership and management of a company to the next generation, whether that's family members, key employees, or an outside buyer. It's a delicate intersection of finance, law, and family dynamics, and it requires a dedicated team of professionals. The role of the accountant or CPA in this process is to establish the financial foundation. The very first step in any succession plan is to determine what the business is worth. An accountant can perform a detailed business valuation, analyzing financial statements, assets, and market conditions to arrive at a defensible figure. This valuation is the bedrock upon which all other decisions are made. The accountant also models the financial and tax consequences of different transfer strategies, showing the family or the owner the numerical impact of their choices. The tax attorney's role is to design and build the legal machinery that makes the transfer possible. A succession plan is not a handshake. It is a collection of legally binding documents and structures created to ensure a smooth, tax-efficient, and predictable transition. One of the most critical tools an attorney uses is a buy-sell agreement. This is a legal contract among the owners that acts as a sort of prenup for the business. It predetermines what will happen if an owner retires, becomes disabled, or passes away. It answers crucial questions. Who has the right to buy the departing owner's shares? How will the price be determined? And where will the money come from? By putting this legal agreement in place early, an attorney helps prevent future disputes and ensures the business can continue without interruption. For family businesses, an attorney may use more advanced legal structures, like a family limited partnership, or FLP. This is a legal entity that can be used to hold the business. The senior generation can act as general partners, retaining control, while gifting minority interests to the next generation over many years. This strategy can be a tax-efficient way to transfer wealth, while preparing the children for future ownership. Ultimately, the business succession plan must be perfectly integrated with the owner's personal estate plan. The tax attorney ensures that the wills, trusts, and business agreements all work together seamlessly to achieve the owner's goals, minimize gift and estate taxes, and protect the legacy they have built. In succession planning, the accountant tells you what your business is worth. The tax attorney creates the legal pathway to transfer that worth to the next generation. Thank you for joining us for this entire series. We hope this exploration has provided valuable clarity on the distinct and vital roles of these two key professions. Welcome back. In this chapter, we address a deeply personal and often difficult life event that has profound financial and tax consequences: divorce and separation. The decisions made during this process can impact each person's financial health for many years to come. It is a time when the distinct expertise of both an accountant and a tax attorney are often critical to achieving a fair and equitable outcome. An accountant's role during a divorce is essential for creating a clear and accurate financial picture. They assist in gathering and organizing years of financial records, from bank statements to investment portfolios. This financial disclosure is the foundation of the entire settlement negotiation. An accountant can also calculate the cost basis of marital assets, like a home or a stock portfolio, which is vital for understanding the future tax consequences when those assets are eventually sold. They can also help with post-divorce tax planning, such as determining the correct filing status, or who is eligible to claim the children as dependents based on the final legal agreement. The tax attorney's role, however, is to proactively shape the tax outcomes within the divorce settlement itself. The separation agreement or divorce decree is a legally binding contract, and a tax attorney works to ensure the language in that contract protects their client's financial future from a tax perspective. A primary area of focus is the division of assets. While the transfer of property between spouses during a divorce is generally a non-taxable event.
Disclaimer: this video is for informational and educational purposes only and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.
Not all assets are created equal after tax. For example, receiving $1 million in cash is very different from receiving $1 million stock portfolio that has a low-cost basis and will trigger a large capital gains tax when sold. A tax attorney understands these nuances and negotiates a property division that is truly equitable after considering these built-in tax liabilities. Furthermore, a tax attorney negotiates responsibility for past tax issues. Who will be responsible if a previously filed joint tax return is audited? Who pays any outstanding tax debt? A tax attorney will negotiate these points and ensure the resolution is clearly spelled out in the legal decree, effectively creating a private indemnity agreement that can protect a client from their former spouse's tax problems long after the divorce is final. In the complex process of a divorce, an accountant provides the crucial financial data and analysis. A tax attorney uses that data to negotiate and draft a legally sound settlement that anticipates and resolves tax issues, providing critical protection for the years ahead. Welcome for the final time to our series. Having explored the many complex situations where you might need professional tax help, we will leave you with a practical framework for making one of the most important decisions: how to choose the right professional for your needs. This is not advice on who to hire, but rather a guide on how to evaluate your options to make an informed choice. First, clearly identify the nature of your problem. Ask yourself the core question this series has been about. Is my issue primarily about compliance and reporting, or is it about a legal dispute, risk, or structure? If you need help with accurate record keeping, filing your annual returns, or managing payroll, your search will likely start with an accountant. If you are facing an audit, a court case, a collection action, or need to structure a complex transaction, a tax attorney is likely the professional you need. Second, verify their credentials. Credentials are the baseline proof of qualification. For an accountant, look for a certified public accountant or CPA license. This signifies they have passed a rigorous exam and are held to a high ethical standard. You may also encounter an enrolled agent, or EA, who is federally licensed by the IRS to represent taxpayers. For an attorney, the essential credential is a state bar license in good standing. This is the legal requirement to practice law. Many specialized tax attorneys also have an advanced law degree called a Master of Laws in Taxation. Third, evaluate their specific experience. Credentials are not enough. You need someone who has experience with your exact problem. Don't be afraid to ask direct questions. For example, how many cases like mine have you handled? What is your experience with IRS appeals? Or can you describe your experience with international tax compliance? A reputable professional will be able to speak clearly about their experience in the area you need help with. Finally, understand their communication style and fee structure. You will be working closely with this person on sensitive matters. It's important that you feel comfortable with their communication style. Additionally, you should have a clear written understanding of their fees before any work begins, whether they charge by the hour, a flat fee, or require a retainer. By using this framework, identifying your problem, verifying credentials, evaluating experience, and understanding fees, you can move forward with confidence, knowing you have found the right professional to help you navigate the complexities of the U.S. tax system. Thank you for joining us.
Disclaimer: this video is for informational and educational purposes only and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.